ICT doesn't work anymore. Well, that's what a lot of you people think. But in reality, you don't have a clear setup, a clear strategy, a rule-based strategy that you can follow every single day and take trades. You are all confused looking at different patterns, looking at different strategies, but you don't have a clear edge, a fixed edge that you can use every single day. Well, in this video, I'm going to teach you my one setup for live trading strategy. It uses the 10 a.m. power of 3, and it is very easy. So let's get straight into it. So one model for live, and I can use this whenever the setup is presented to me. I have so much confidence in this setup that when it plays out, it's going to give you 1 to 2, 1 to 3 with ease. All right. So this is let me just do that, rule-based strategy. Okay. There are rules that you have to follow, and when you follow, you're going to see trades playing out. So it is a rule-based strategy, no confusion whatsoever. I'm going to teach you a mechanical way to identify your bias. So again, you don't have to be confused. You don't have to worry that you are wrong, you have a wrong bias, or you don't want to be lost, right? So I have a mechanical way that will help you identify your bias for the 10 a.m. candle, okay? And this strategy is stupid simple but profitable. When I'm going to show you guys some examples, and when you are going to go and backtest this, you're going to see the setup play out again and again. And number 4, you're going to get big risk reward ratio trades. So they're going to be 1 to 2, 1 to 3, even 1 to 4 sometimes. So let's start with what exactly is the setup. Okay. So as you can see, I have highlighted this 10 a.m. candle on the 4-hour time frame. So these are all 4-hour candles. Okay. And this works for futures. Okay. Futures only, NQ futures, gold futures. When you're trading NQ futures or any futures, you will see the 10 a.m. candle open as at 10 a.m. Okay, the 4-hour candle. So if you're trading CFDs or Forex, you're going to see 9 a.m. instead of 10 a.m. So you don't want to trade that. Okay. So here is the strategy. First of all, we will be trading the 10 a.m. power of 3. Now, what essentially is a power of 3? It is a accumulation phase, and then a manipulation phase, and then a distribution. So A, M, D. Accumulation, manipulation, and distribution. Accumulation is just consolidation or sideways price action. Manipulation is a liquidity sweep or a tap into a higher time frame fair value gap, because a high time frame fair value gap, it is basically a low on the lower time frame. If you check it, it's going to be the low. But this is the manipulation, and distribution is when we get the move to the original direction, right? So here is what we're going to do. So we're going to be trading the 10 a.m. and we're going to be entering somewhere around here on the 10 a.m. candle. Okay, so when it opens, I want to see what? A manipulation move. Okay, and then we're going to catch the move to the upside. But how do we know that price is going to manipulate to the downside instead of upside, right? And how do we know that price is going to distribute to the upside? Well, that's where the mechanical way to identify the bias for the 10 a.m. candle comes in. So we will be identifying our bias with the 2 a.m. candle and the 6 a.m. candle. Again, I'm going to repeat, these are all 4-hour candles, okay? So we have the 2 a.m., the 6 a.m., the 10 a.m. Again, we're going to be trading the 10 a.m. one, but we need to identify our bias for the 10 a.m. by using these 2 candles. So if the 6 a.m. candle closes above the 2 a.m. candle's high, then our bias for the 10 a.m. is going to be bullish, okay? Very, very simple stuff. Now, what if we reject off this level and we just leave a wick, right? So let me just do this. We leave a wick, we get a rejection. Now, in that case, our bias is going to be bearish. Okay, so let me just do that. Because we couldn't close above the 2 a.m. high, so in that case, our bias for the 10 a.m. candle is going to be bearish. And let's just go here and turn this red. So, never mind. So that's what you're going to get on the 10 a.m. and we're going to try to enter somewhere around here, okay? And I'm going to also teach you a mechanical way to identify the correct manipulation move, so you will know exactly where the manipulation ends. But this is pretty much the entire rule, right? If we get a rejection of the 2 a.m. and the 6 a.m. candle wicks above the 2 a.m. high and then closes below, then you can say that, okay, our bias for the 10 a.m. is going to be bearish, all right? And similarly, vice versa for, longs. If I invert the chart over, let's say that we closed bearish right, on this candle. And we closed below the low of the 2 a.m. candle. In that case, our bias for the 10 a.m. is going to be what? It's going to be bearish. Yep. It is going to be bearish. All right. So pretty much we're going to be opening around this area, right? We might have a wick around this area, whatnot. But if we close below the 2 a.m. candle's low, then bias for the 10 a.m. is going to be bearish again. And then we're going to be taking our short position somewhere around here. I'm going to teach you everything, the entry model and how you would proceed with this, right? And then one last scenario is where you just wick above it and you don't close below the 2 a.m. low. So the 6 a.m. fails to close below this, right? And what if we wick on the both sides, right? So that is a lot of people ask me this question, is that what if we wick above the high and low of the 2 a.m. candle? In that case, you just want to stay still. You don't want to take trades, and you're going to wait for the next day. Not every day is a trading day, so you have to skip trading on that specific day. But if we have a clear direction, so let's say we wick and close above, then in that case, our bias for the 10 a.m. candle is going to be bullish. It's really that simple. That's what you need for your bias, okay? So let me just turn this green. All right, so the 10 a.m., we're going to be entering somewhere around here. Now, how do we know how to enter this trade, right? So let me just remove this since we know how to identify our bias in a mechanical way. Now, let's say that our bias is bullish, right? Now, this is the 4-hour candle. And this is what's going to look like on the lower time frames, right? So we're going to be opening around this area. We're going to have some sideways price action. We're going to wick below, and then we're going to push up. Okay? So you can see this is the wick, right? The lowest point. We had accumulation, manipulation, and then we closed bullish as a candle. Now, how do we know how to identify the correct manipulation move, right? Because that is what is the most important thing. So let me just do this real quick, guys, so it's very clear for you. I don't want to make a mess out of this. So let's do this, and this. Okay, so again, we have accumulation, we have manipulation, and then we have distribution. Now, what you want to do from here onwards is as soon as the 10 a.m. candle opens, you want to drop down to 15-minute time frame. So this is going to be the 15-minute. So first you want to drop down to 15-minute time frame. All right. Now the next step is you want to identify unmitigated 15-minute fair value gaps below the opening price. Okay, below the opening price, because we are looking for longs. So we're going to be using bullish fair value gaps. So we open here. Let's say that, okay, this is way far down. My bad, guys. Okay, so this is the lowest point. Okay, so what we want to do is identify a 15-minute fair value gap. Okay, let's just make this a bit soft. Okay, so if price taps into the 15-minute fair value gap, we have the open. There's a 15-minute gap here. We tap into it. What you want to do next is just drop down to 1-minute time frame. As soon as we're inside the 15-minute fair value gap, we want to drop down to 1-minute time frame. And then from here onwards, you can either look for inversion setup. So if from this dealing range high to this dealing range low, if there are 2 or 3 fair value gaps, you want to wait for all of them to get inversed. Or you can take a market structure shift and fair value gap entry, the basic, the 2022 model, right? So let's say we get a market structure shift here. You can take your entry from a fair value gap or a breaker block or an auto block. But I'm going to give you a little sauce that's going to help you identify the manipulation moves with insane accuracy, all right? So even though you can use the fair value gap by itself to confirm the manipulation, that the manipulation has ended here, if you use the standard deviation tool, right, from the last manipulation leg. So for example, during the accumulation phase, what you want to do is identify a market structure shift during the accumulation phase, okay? So we have the accumulation going on around this area. Now notice here we have a market structure shift, right? Last low that was formed and the last high. So we want to use our fib tool from the last high that was formed to the last low before market structure shift around this area. Now the manipulation move usually ends at -2 and -2.5 of standard deviation. So these are the settings if you want to copy them. And if that aligns with our 15-minute fair value gap, that is A+1 setup for live trading model, right? You can take that setup with your eyes closed. So again, we have a 15-minute fair value gap, right? Price accumulates, price opens here, the 10 a.m. candle opens here, it first accumulates, manipulates into the 15-minute gap, our bias is bullish, and then we look for a market structure shift. Now, if there is no 15-minute fair value gap, right, that formed for the entire day, which is very unlikely, you can use the 5-minute fair value gap as well. So if you can't identify 15-minute and there's a clear 5-minute fair value gap, you can use that as well, okay? And I'm going to give you guys some examples and you will understand what I'm talking about. So again, we use the standard deviation from the last market structure shift level, last high to the last low, before price manipulated. And if the manipulation phase taps into the -2 and we get a market structure shift, take your setup from the fair value gap or a breaker block. And again, we need to be inside the fair value gap. Now, a last scenario, and then I'm going to move on to the examples, is what if we don't have a 15-minute or a 5-minute fair value gap? In that case, what you want to do is identify key liquidity levels. So this could be London low, could be Asia low, or a very strong 15-minute low. Okay, so let's say that there was this extremely significant low and price swept that, but there was just no fair value gap. Now, if price sweeps that low, but we also get standard deviation, price tapping into -2 and -2.5 of standard deviation, take that setup. It's going to work out as well. So now that we have understood this strategy, let me give you guys some examples. And if you want to watch me live trade for absolutely free, right, there's a link down in the description. Click on it and secure your spot. It is free. You can come and watch me for a few days and make up your mind. Let's move on to the examples now. All right, everyone. So here is example number 1, looking at NQ, right? And first thing first, we have the 2 a.m. candle, the 6 a.m. candle, and the 10 a.m. candle. So if you look at it here, we closed below the low of the 2 a.m. candle, and the 6 a.m. candle was bearish. So our bias for the 10 a.m. candle is going to be bearish as well. So what we want to do is we want to mark out the opening price, right? And let's just check if we had any fair value gaps to the upside of the opening price, right? So this is the open. And if you look closely, what we have is a 15-minute fair value gap. All right. Now let's drop down to 1-minute time frame and confirm our manipulation. Now, one thing I want to tell you is that if we tap into a fair value gap, looking at standard deviation is not necessary. But what it does, it solidifies your manipulation move, right? It gives you more confidence. So what we have is a low and a high, right? The last low before a break of structure or market structure shift around this area. Price taps into -2, -2.5 around this area. That is good. Now, once we tap into the fair value gap, we have to look for a market structure shift. And right here, we have a market structure shift. And then we have an auto block here, right at the open. So the opening price is also an auto block, right? So this would have been your entry. Your stop loss would go right above the high. And you can go for 1 to 2 risk to reward if you like. All right. I'm not sure what price did, but eventually I think it kept dropping to the downside, if I'm not wrong. So in that case, if you want to find your targets as well, you can use your fib from the last low. Sorry, the last high to the last low. And when you take your entry, you can target the -2 standard deviation. Let's move on to the next example. All right then, so here is example number 2, looking at NQ on the 4 hours. So we have the 2 a.m. candle and the 6 a.m. candle. So the 6 a.m. candle closed below the 2 a.m. candle's low. So our bias for the 10 a.m. is going to be bearish. So let's mark out the opening price and see what happened inside this candle. Even though it looks like a bullish candle, but you will see what happened. So let's drop down to 15-minute time frame. And we have the open here. Look to the upside. What we have a 15-minute fair value gap. And this happened today, by the way. So we tapped into the gap and we pushed down. So now as soon as it taps into it, we're going to drop down to 1-minute time frame. Right? And since as I already said before, if we tap into a fair value gap, you don't need standard deviation. So you can see that even though the standard deviation projection was around here, sometimes it's going to tap the fair value gap and push down. Okay. So right here, we tap into the fair value gap and we get a market structure shift, right? Then right above us, we have a fair value gap in the premium of this dealing range. This would have been your short position around this area. Your stop would go right above the high and you would go for 1 to 2 risk reward. Simple as that. Price did go down as well, but you can see even though the candle looked bullish, there was a huge move to the downside till here. And that's what the bias does, right? It gives you a clear mechanical edge that you can use every day. Let's move on to the next example. All right, here is another example, and that happened on November 10th, so 2 days ago. So we have the 2 a.m. candle and the 6 a.m. candle. The 6 a.m. candle closed above the 2 a.m. candle's high, so our bias for the 10 a.m. candle is going to be bullish. So let's mark out the opening price, and I can already see we tapped into this 4-hour gap down there, right? We tap into it, but let's refine it even further. So let's drop down to 15-minute time frame. So we had this fair value gap that didn't get respected, so we burst through it. Now what we had was the London low, Asia low, and then also what we have is a fair value gap on the 15-minute that is unfilled, untapped. So that's what we want to use. We don't want to use the fair value gaps that are already mitigated. So this one was mitigated, but this one wasn't, right? So now we swept this significant pool of liquidity, all these equal lows. We tapped into the fair value gap. So from here onwards, I would drop down to 1-minute time frame to look for my confirmation entry. And right here, we had some chop, but then eventually what happened is that we had this breaker block. So we couldn't get a good market structure shift, but as soon as we closed above this breaker, this would have been your long at the retest. Your stop would go below the low, and you would target these equal highs that are very juicy to the upside, right? So you could have targeted that as well, giving you 1 to 2 with ease. Let's move on to the final example, and then I'll end the video. And again, if you want to watch me live trade this model and other models, you can join for absolutely free. Link down in the description. All right, so here's the last example. We have the 2 a.m. candle, the 6 a.m. candle, and the 10 a.m. candle. The 6 a.m. candle closed below the low of the 2 a.m. candle. So our bias for the 10 a.m. is going to be bearish. And we also have this draw on liquidity down there. So let's mark out the opening price of the 10 a.m. candle, right? Let's drop down to 15-minute time frame. And right here, you can see that after opening price, we formed a fresh fair value gap, okay? So as long as the fair value gap is above the opening price, we can use it. We cannot use the fair value gap that is, let's say, below the opening price. So let's mark out this fair value gap and see what exactly happened. Let's go to the 1-minute time frame. We tapped exactly into that fair value gap. And there would have been a couple of ways that you would have entered this. So we had inversion to the downside. You could have taken that. Or we had a fractal market structure shift. You could have entered off directly from here. But I would personally take the inversion setup. This looked way cleaner with this big bearish candle. Entry would be here. Stop would go right above the high. And then again, we can use standard deviation for our targets. So the -2 is perfectly aligning with this low over here. So I would personally just target this low, even go for 1 to 2. 1 to 2 is minimum with this strategy. So that is pretty much it. I'll see you guys in the next one.